And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
And welcome to my podcast. Okay, so a lot is going on. And what's unfortunate is Wall Street, they're not about to explain to you what's going on, okay? Because they don't want you to know. Because they can manipulate, all right? And they've been manipulating retail investors for years. They usually call them the retail investors. They say, well, they have a herd mentality. We can move any stock we want. And that's how they make money. They're not there to help you. They're helping themselves. And it goes all the way back to discount brokerage. When discount brokerage came in and they weren't making, let's say in today's money, they weren't making $200 commissions anymore, but $5 or $15, the whole system changed. That's when they decided, you know what we got to do to make money? Two things. One, we got to go in and buy the stocks first, and we'll mark the stocks up to our retail people. That's the first thing they did. So that's like going to Brooks Brothers and buy a suit for $500, thinking you go out and sell it for $1,000 in front of the store. You can't make money doing that. That's one of the reasons why almost 70 to 90%, actually it's around 90% of people, retail investors, lose money. That's one reason right there. But people don't understand how the market works. They don't even know where the money goes. So what we're seeing in the market right now, okay, is, again, we never see yields going up like this. Normally, when you have yields going up, it's because you have a good economy. Things are terrific. Wages are going up. Plentiful jobs, full-time jobs with good benefits. That's not happening. So we got yields that are soaring all for the wrong reason because of the bond market. Because oil keeps now we're almost near $100 again. We may be there, I'm not sure, last time I checked. But oil is the killer. So when you get oil to $100, it changes everything. The last, I think, 6 crashes we had were due to oil. So I thought today I'd go over some things that I explained that nobody on Wall Street would take the time to explain to you. Why are we in such a mess to begin with? I mean, this is a mess. How can you have yields going up? Makes no sense. Makes no sense. Interest rates going up. It's not like there's a demand. And we better, before we get inflation, we better, raise rates. We better cut. No, we got a situation where, again, the government. Let's go back to where all this mess started, where oil's going crazy, yields are going crazy, bond market wants more yields. It all started when the government starts overspending between 2008 and today. Now, what do I mean? We are in this mess, and it's not easy to get out of, and we can go, never mind a recession, we can go into stagflation. Once you're stagflation, you're really screwed, because stagflation, your economy keeps going down. Prices keep going up. Stagflation is terrible. Recession, you can get out of those pretty quick. But here's what's going on. The government has been overspending, and Congress keeps allowing it. Those dopes that we have in Congress, they don't do their job. That's one reason. Now, who caused all this? Now, I don't want to hear, it's Trump's fault. Everything's Trump's fault. This is the fault of the presidents between 2008 and 2026. Because they would keep running deficits, terrible deficits, keep spending more money they took in. and Congress would approve it. So if you take G.W. Bush in 2008, he started all this. This was a mess. He started this whole mess. You can thank him. But it wasn't just him. Between 2010 and 2016, Obama spending went wild. 2017, 2020, Trump spending went wild. 2021, 2023, Biden spending went wild. Get to 9% inflation. Oh, but nobody wants to talk about that. 2025, 2026, Trump again, spending. Our spending is crazy. Our deficits are crazy. Deficits are exploding. That's where our mess is. That's why when you sit there and you see yields are going up, you see oil going up, and yields are going up for the wrong reason. If yields are going up, you want them going up because there's good news, there's a good economy. That's not what's going on. Deficits are exploding because government keeps borrowing. And what do? How do they borrow? They need money quick, fast, like now. They got to keep the lights on. Now, when I say that, I'm not making a joke. When I say they got to keep the lights on and they got to pay the people in Congress and they got to pay the government workers, I mean, they need that money now. So where do they go to get the money? The government issues T-bills. T-bills are issued every week. T-bills are cheaper than a 10-year treasury. So that's one of the problems we're having right now. So they keep issuing T-bills, 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 T-bills. And that's becoming a real problem because what happens is the consequences are terrible. Because when you keep issuing these T-bills like crazy, this is short-term debt. 1 month, 2 months. Money is coming out of the system. Cash is coming out of the system. And again, we've been shorting gold stocks. We just started to short gold stocks, I think about a week ago, if I'm right. And everybody said, why is gold going down? Shouldn't gold go up? Because again, everything's upside down. They're dumping gold. Why? Because 95% of the people who buy gold come from Europe. And the Europeans, when they see where the exchange rate is right now, they're not going to take their currency and buy dollars and then come here and buy gold. So that's another reason why you're seeing gold starting to drop. And everybody's going, why are you shorting it? Why? Gold should be terrific. Look what's going on. We have a mess in the country. We have debt. We have everything going on. People are going to go to gold for safety. No, they're not. They're not going to go gold for safety because who does all the buying? Europeans. And they're not going to take their currency and go in and buy dollars. What are you, nuts? Not going to do that. So the consequences, when you have these deficits, one of the biggest consequences is investors, as I say, pull money out of the system, out of their savings, out of their checking account, out of their 401ks. And what happened is this. Powell started to panic. So why? He sees bank reserves are dropping. So he says, I'm going to discourage anybody from wanting a loan. So I'm going to keep rates up. Remember the fight that Trump had with him about the rates? You got to cut rates. And he said, I'm not cutting rates because he saw the reserves going down. Remember why reserves go down? Because anybody's got a savings account or CD or whatever at the bank, they're pulling that money out left and right, and they're buying T-bills. They can get, what, 4%, I think, right now on a T-bill. So that's what's going on. So one of the consequences that we're having right now, because Congress approved from Biden, all these 4 presidents, spend as much money as you want. Don't worry about deficits. We'll issue T-bills. We can issue them once a week. We can T-bills out for 30 days, 60 days, 90 days. And it's cheaper than a 10-year treasury. So this is where the mess started, and that started with G.W. Bush. And then came along Obama. He was just as bad, and so on. Now, so investors are pulling their cash out of the financial system. Powell panics. He's not going to cut rates. He discourages borrowing, and he kept rate too high for too long. Now we got a real serious problem. If the rates are too high for too long, and all of a sudden we start seeing oil go up, for the wrong reasons, not because of demand or a good economy, because of the war. When oil starts going up, what happens? You start seeing the bond people saying, hey, that's inflationary. I'm sitting here, I'm in the bond market. You want me to take a hit on inflation? No, that's not going to happen. We want higher yields. We want higher yields. So that means liquidity now starts getting tight. Now, what does liquidity mean? Well, liquidity means, well, first of all, I want you to understand this whole thing got screwed up because, again, these 4 presidents kept spending more money than were taking in revenue. We also had a dope for a chairman of the Federal Reserve. He would not raise rates because he doesn't understand. And the people who work at the Federal Reserve aren't business people. They're dopes. They're highly educated nincompoops. That's what they are. Okay? I mean, I remember they had their, what's her name? I can't remember her name. I call her Aunt B. But she never had a job. I wish I could remember her name. Anyways, she could, it'll come to me. But anyways, Yellen, thank you, Yellen. She's never had a job in the private sector, never. She's always been an educator. She's an educating nincompoop. And she's running the Federal Reserve? No wonder you get in trouble. Anyways, so what happened is that when you get into a situation where investors are pulling all their money out of the banks, they're finding T-bills being attractive, then all of a sudden the next problem becomes liquidity gets tight. What does that mean? That means that no more low yields. No, and remember what drives stocks. What fuels the stock market? What's the fuel? What's the rocket fuel to push stocks up? Is liquidity, low yields, easy credit, low funding costs, especially for small businesses. That's what drives the stock market. Everything else is total BS. The fundamentals are BS. So liquidity now starts getting tight. So there's consequences when liquidity gets tight. That means there's no more low yields, no more easy credit, no more low funding costs. That's gone. That's out the window. Now everything gets tight, which means high yields, high credit or tight credit, no more easy credit, high funding costs. I mean, this really hurts the economy. Now, tight liquidity also means when you no longer have access to cheap money, easy credit, what happens? Higher yields. There you go again. Higher yields are going up for the wrong reasons. Remember, high yields go up. You want higher yields going up for the right reasons. Okay, people are happy. You got a strong economy, strong full-time jobs. People are getting good benefits. That's not what's going on. So tight liquidity is here now. That's why you got to learn how to sell short, because high yields will kill you. Will kill you. You know, if you look at the 11 sectors in the market, most all these sectors are driven by what? Low yields, not high yields. So anyways, you got tight credit, slower lending. Banks aren't going to lend you. Try to go get a loan today. See how long it takes you. And then here's the killer, IWM, the small mid-cap stocks, the heart of the industry, of this whole Wall Street. IWM is the heart of our economy. IWM is the small mid-cap stocks. That's Main Street. You want to know if your market's going to go up or down? Don't ask a broker. Look at IWM. If IWM is going down, you're in good shape. If IW is going up, your market's going to stall. Just like yields. Yields go up, you're screwed. You're screwed. Another consequence of all this liquidity, tight liquidity showing up, which Wall Street's not even talking about. Nobody's talking about tight liquidity. They always talk fundamentals, but no tight liquidity. So tight credit, slower lending, weaker small caps, strong dollar, oil spiking, market volatility, slow GDP. That's what it means with tight liquidity. And tight liquidity means no more credit, you're screwed. Now, remember, when you start sucking liquidity out, when everybody starts buying all these T-bills, and this becomes a real problem, because where does that money go? It gets pulled into places where it can't circulate. Now I'm going to go on for a few more seconds here, so I can complete this for you, because I think this is important for you to understand what's going on. The T-bills. Let's talk about T-bills for a moment. So when money stops flowing through the financial system, because it's getting pulled into these T-bills, and it goes into places it doesn't move anymore, doesn't circulate. That's going to take this market down even more. But you don't hear anybody talking about it, do you? No. Because T-bills, treasury bonds, money market funds, okay, they're all locked in. Okay, that money doesn't move anymore. So the bottom line, when liquidity gets sucked out of the system, and the money gets sucked out of the system, disappears, it gets trapped in places that don't circulate. It gets trapped in T-bills, money market funds, bank reserves, and a strong dollar. That will really screw your market up for you. That's another problem. Oil is soaring. Nobody understands why. There's no demand for it. Oh, they're telling you there's great demand for oil. That's a bunch of BS. No, oil's not soaring because there's demand. Oil's soaring because there's a war. And people start worrying about supply. Look at the most strait, okay, they're fighting over there about. So, and also what happens is when money gets tight, liquidity gets tight, all these big drillers that have to go get that oil out of the ground or out of the ocean, they can't get funded. So that's going to keep pushing oil up. So this whole point is this. Everything is looking at oil. Oil could probably go to $125. Every crash we've had has been surrounded by oil prices, almost every one. So the idea that this war also is going to stop today and oil is going to drop back to $65, it could. I was in the oil business for 25 years. I know the business. I know how it works. I know exactly what goes on in the oil industry. I mean, all Trump has to do is get up one morning and just make a speech, say, we won, war's over. But there's a reason all these countries aren't participating with us. They don't want to get dragged in. Because remember, those whack jobs over there, those whack-a-mos, they fight. They know how to fight. That's all they do. When you send kids to kindergarten, where do they send their kids? How to assemble and disassemble a rifle instead of kindergarten. How to kill. These people, for hundreds and hundreds of years, remember, it's the only place they can make money. There's no job opportunities. So to think that they're just going to send bombs in there, and no war has ever been won by the air or by sea. You got to put boots on the ground. Boots on the ground. So this war is far from over. Okay, now they've done a fabulous job. There's no question about it. Remarkable what they've done and accomplished. But you're still going to have to put boots on the ground. They're going to have to go get Carr Island, take it over. I mean, this is a mess. So, but it's not a mess for the stock market if you know how to sell short. But Wall Street doesn't want you to sell short. They scare you to death. Oh my God, you sell short, you're going to go blind. You sell short, you're going to lose your first child. And why do they do that? Because they don't want you to short. Because they need you to keep buying So when stock's going down, they can get out, and they can get the pension funds out. Just like Enron's a classic case. I talk about it all the time. When Enron was going down, what did they have you doing? You were buying more shares on the way down. What happens when the market is going down and when pricing's going down? Pricing is trend. When your stock price is going down, it's developing a channel, a downward channel, and they have convinced you to keep buying. Isn't that amazing? And people do. It's a killer. Now, as far as where we are right now, oil, as I said a moment ago, is not about demand. And as long as the bond market is active right now, they're going to demand higher yields. Look at the bond market. Last week we were down to what, 4%, right where that safety net was. So I just don't see this getting over early. I just don't, unless we walk away. So I think there's some great shorting opportunity. Gold, God, we hit gold just perfect. We hit all the gold mining stocks. I had everybody shorting gold mining stocks. It was a perfect move because I knew that gold is going to drop. Everybody said, well, no, it's not, Phil, because everybody uses it for safety. Well, that's true, but the problem is the biggest buyers of our gold, besides all the central banks around the world, are all the Europeans. They're not going to buy gold. They're not going to, as I said, there's an exchange problem. So again, all the stuff that's going on right now that they're telling you from Wall Street, it's all BS. It's all BS. The only opportunity you got right now is to learn how to sell short. God, it worked. Just go take a look at what we're shorting. We got more. I said to my gang today, we've never had so many shorts on board. I've been in this business for almost 40 years. I said, I've never had that kind of amount of shorts. I've never seen that before. So we'll see. But shorting's fun because the stock market goes down 10 times faster than it goes up. Once you start shorting, it's like eating peanuts. You can't stop. Okay, well, I hope I helped you understand how this thing works. So again, liquidity. Always remember liquidity is the fuel. Is the rocket fuel that drives the stock market. Don't listen to all the BS they give you on Wall Street. And when that fuel, liquidity, when you don't have easy credit anymore and easy access to money anymore, boy, that screws up Wall Street. That screws up the economy, and that's where we are right now. And double that with high oil prices, I don't see this over for a while. So learn how to short. We'll help you with it, okay? All right, see you on the charts.
Are you nuts?